And welcome back to You Heard It From a CFP. My name is Matthew Coyle, back in the office downtown Minneapolis. Today it is episode 48 of You Heard It From a CFP. Hope you are well. Today we are talking about 401k or other qualified plan rollovers. Should you roll over a qualified plan, such as a 401k, 403b, even a pension perhaps? What are the pros? What are the cons? Let's dive in. All right, so it's a quiet Friday in downtown Minneapolis. Perfect time to do a video. Let's talk about rollovers. We do a lot of rollovers at ACG. What is a rollover? A rollover is when you move money from a qualified plan into a personal retirement account. So a perfect example of this would be going from a 401k into an IRA, for example, or a 403b into an IRA, or a pension into an IRA. It's when you roll over or transfer tax-deferred money from a qualified plan into an IRA. That is a rollover. You're allowed to do it once per year. And let's talk about the pros and cons, the benefits of that, why you would do it, why you wouldn't do it. And we'll start with number one. We'll start with the pros first, and then we'll do the cons. Okay, we'll do three pros here. Number one, lower product and fund fees. It's very, very possible, depending on the 401k plan you have, that it's very, very accessible to get lower fees and lower fund costs from the current investments you have in your 401k. 401ks only have a menu of selected options you can choose from. You cannot get anything in a 401k. There's certain restrictions. An IRA has a lot more flexibility. So number one, you may be able to lower your fund costs and your product fees by using an IRA rather than using a 401k, which tends to be mutual fund based and can be more expensive or cannot be. Depends on the 401k you have, but there can be lower fund fees inside of an IRA. That is number one. Okay, number two, access to private investments or other types of alternative investments. You know, it is obviously not allowed in 401k plans to invest in things like hedge funds or private equity or other types of alternate investments or private credit, for example, that might offer you some benefits if you are a high net worth or higher income investor who has access or the ability to participate in some of these products. It's a growing marketplace, as I've detailed in other videos in the past. There are a lot of people who like to invest in private equity and private investments of various kinds. Or if you own an LLC or you want to have private shares in a company that maybe you want to invest in that is owned by a family member or a friend or a colleague. There is a lot of avenue for investment inside of an IRA, for example, that you don't have inside of a 401k. So executing a rollover from your 401k to your IRA to at least put some of that money into private or alternative investments can be a very beneficial and quite a great planning move from a personal financial planning standpoint. So number two is access to private or alternative investments. Okay, number three, you would like some assistance or some advice from a personal financial planner, money manager, or similar professional. So if you're in a 401k plan, your 401k plan already has a manager attached to it. You know, I run into a lot of situations where I hear the client has their 401k being managed by another advisor and being charged for it. Let me clue you into something a little bit here. You do not need to be charged a separate fee from your advisor for managing your 401k. Your 401k already has a manager who is also charging fees for that service. If you allow your advisor or financial planner to charge you for the purposes of managing your 401k, as long as it's in that set of already, that menu of investments that they already have, then you are just duplicating your fees. There is no point in having an advisor or a planner manage your 401k, which is also, by the way, being managed by the mutual fund companies in which those funds are invested. So in essence, you're kind of tripling your fee. However, there is a good reason if you are the type of person who would like some access to private investments or whatever, and you want the advisor to help you in a planning context, in the context of everything else that they're doing for you, then it makes a lot of sense to roll to an IRA as long as you qualify. So if you have an advisor who wants to manage your 401k for you and charge you for the privilege of doing that, then the only reason to do that is to move it to an IRA. You would not have that person manage your 401k for you. So if you want an advisor or a tax person or investment advisor, whoever, to manage your funds, then you would move them to an IRA, and that justifies the cost of doing that, and then you can do everything else wrapped up in the planning context that you're doing. So if you want help from an advisor, money manager, or other type of professional, then moving to an IRA makes a lot of sense. All right, next up, estate planning considerations. You know, there are some products in our industry that just don't transfer well from an estate planning consideration unless you buy an extra death benefit or some type of rider on top of that, which just adds to your cost. What I find with pensions, for example, is that if you do not want a pension, don't need a pension, or maybe you're a little higher asset, don't need the income, a lot of times pensions are a little bit unnecessary, and you can maybe do a little bit better in the marketplace by investing the dollars with the lump sum that they offer. So when a pension rollover comes up, for example, it's often because pensions and annuities don't transfer very well from an estate planning consideration. They don't have a death benefit attached to them. They're not insurance technically. They're run by insurance companies, but they don't have a death benefit quite often. So the person does not want to take a life annuity only to die 5 years later, and then all that money just goes back to the insurance company. So unless you buy a separate annuity rider or accept a lower payout on the annuity by having a joint and survivor payment, your annuity or pension probably won't transfer very well to your heirs if that's what you want, which is an estate planning consideration. So from an estate planning consideration, you may be better off in an IRA if that's what you want. You take a lump sum, you invest the dollars by yourself or with the help of a manager or planner, and then you have a beneficiary on that IRA who will get the money. And then if you were to pass away, they can invest the dollars on their own benefit. So from an estate planning consideration, it often makes sense if that's a high priority for you to roll to an IRA, particularly from a pension or an annuity, because if you don't need it or don't want it or want to have something that transfers easily for your heirs, then it makes a lot of sense to move that money from the qualified plan into an IRA. All right, so those are some pros. Let's do some cons. So why wouldn't you do a 401k rollover? Why wouldn't you take qualified plan dollars, for example, and move them into an IRA? Well, number one reason why you wouldn't do it, and this is the overriding reason, easiest to point out as the number one reason, is your age. If you are between the ages of 55 and 59 and a half, don't you dare execute a rollover if you think there is a decent chance you're going to need that money between the ages of 55 and 59 and a half. Why? Because you can access, by federal law, you have penalty-free access to your most recent 401k if you retire from your company between the ages of 55 and 59 and a half. Now, once you hit age 59 and a half, you don't have any penalties for accessing your IRA, but you wouldn't move qualified plan dollars between the ages of 55 and 59 and a half from a qualified plan to an IRA because you lose the access, the penalty-free access. You'll still pay tax either way, but you'll lose the penalty-free access if you move it to an IRA and you think there's a decent chance you're going to need that money. So if you're absolutely confident you won't need the money, then a rollover might be okay. But if you think there's a decent chance or maybe even a reasonable chance that you may need those dollars between the ages of 55 and 59 and a half, you do not want to execute a rollover. And I see advisors from time to time encourage people to do this, even when there's a chance, because they want to have access to the money to charge fees on it. So we tell everybody who comes through our doors, do not roll that money over if you think there's a decent chance between the ages of 55 and 59 and a half that you are going to need that money. You do have access to it as long as you leave it in the plan. You have access to your money from the age of 55 onward, as long as it's your most recent employer and you retired from that employer. You do have access to it without any penalty. So don't move it if you think you're going to need access to it. So that's number one. All right, number two, why wouldn't you do it? You are worried about lawsuits. Maybe you work in a very high liability profession. Maybe you're a surgeon. Maybe you're a medical professional of some kind. Perhaps you are worried about getting sued for any reason. Now, there are ways to kind of get around this, but for the most part, you want to probably leave money in a plan or some type of personal account attached within your plan that has ERISA protections, which are retirement law protections that protect qualified plan dollars from litigation and lawsuits. Now, you do have bankruptcy protection inside of an IRA, but you don't have as much protection when it comes to lawsuits and litigation. So if you move money from a qualified plan into an IRA and you're in a very high liability profession and you get sued, chances are, depending on the state you live in, because it kind of falls down to state law, depending on the state you live in, your IRA dollars could potentially be subject to seizure in a litigation or a lawsuit where you are deemed to be liable for someone else's loss. Now, bankruptcy is a different thing. There's bankruptcy protections at the federal level, but the state level, the liability and lawsuit protections differ for IRAs than they do for 401ks. So be aware of it. I also tell everybody I work with or that is interested to hear about it that you need to have a personal liability umbrella policy probably at least $5 million worth, which sounds like a lot, but you can get them for very cheap. They're very inexpensive policies to buy. We all should have one. I have one. You need one, I'm sure. Someone slips and falls on your sidewalk and comes after you, it goes there first and not your qualified plan or IRA dollars. So if you are in a very high liability profession and you are considering moving qualified plan dollars from your qualified plan into your IRA, think about it. There are some considerations. You may want to talk to us about it. But in general, if you are very worried about that, then it's probably better, at least in the short term after you retire, to not move the money from a qualified plan into an IRA. Okay, next one. The ability to borrow from your 401k is now gone if you move from a 401k to an IRA. There are some people who like to take loans against their 401k. I don't like to do it, but it is a feature of a 401k. You can take a very, very easy loan, low interest loan against a 401k. Some qualified plans don't allow it. A lot of them do. But if you move the money to an IRA, you lose the ability to borrow against this particular asset because you cannot borrow against IRAs unless you're doing it privately with a bank or something like that. And that's not very common. So if you want to take a 401k loan, if you think you might need access to something like that, or if you want to do it, again, I don't really do it, but a lot of people do. And it depends on your plan whether or not they allow it. You can take a 401k plan loan. You cannot do this in an IRA. So it's one feature you will lose if you move from a 401k to an IRA. It's kind of lower down the list, but it is a feature you want to be aware of if you think you need that. I prefer to borrow against home equity or borrow against life insurance policies to do this kind of thing. But if you don't have those kind of options and you want to borrow against a 401k, let's say maybe you're not a homeowner or maybe you don't have life insurance policies you can borrow against or don't have cash reserves. Some people like to have access to borrow against their 401k. It's understandable, but it's kind of lower down the list. So if you need that provision and your plan allows it, you will not have access to an IRA to borrow against the IRA. So there's one thing you might want to think about too, is access to credit if you need it. All right, and finally, let's talk about fees. You do not want a qualified plan dollar transfer into an IRA to markedly increase your fee. Sometimes an increase in fee can be justified depending on the services that you're getting. You might get some planning services that you wouldn't have access to through your 401k. We try at ACG at least to match or come very close to the 401k cost using low product fees and an advisor cost together, which is very close to the 401k cost they had before they did the rollover. This may not be available for you. You need to very clearly understand what fee structure you're getting into with the advisor if you're going to execute a rollover. So make sure that when you do a rollover, you're not significantly increasing your cost based on the services that you're getting. It might increase a little bit or it might not increase at all, but you want to be aware of what the fee structure is going to be after you make the rollover because a lot of advisors will raise the fees significantly in the name of doing planning work that might be a little bit cheaper and available someplace else, or you may be able to do yourself. So be aware, at least aware of what the fee is going to be. Make sure it's worth the cost. And if you can, try to work with your advisor to get it down very close or similar to where your fund fees were before you made the rollover. All right, well, that's it. Pros and cons of a rollover. Of course, there are more pros and more cons. I'm just doing a very brief video about it. We are ACG. You have a very nice day. I'm Matthew Coyle. Remember, always, your most valuable asset is, of course, your time. And I appreciate yours. Thank you very much for watching the videos. I know you guys like to keep up with it. And we will be back with another one at another date. You have a very, very nice day. Thanks again. I wish you the best. Take care.